I want to talk about a very easy setup that's very easy to identify. And we're looking at this on gold on last night's trading, which is 2nd of May. Okay. Firstly, the setup needs to be in the New York session. Okay. Now, you can see here, I'm talking about this day here. Let me see if I can draw on this chart. So this is the trading day that I am referring to. Okay. And what I want you to see is I want you to notice this pump up on the day before. Okay. Now we have a pump up there at some point. That pump up is really for the market to come back down. Okay, if the market wants to go down, then it typically takes traders in the wrong direction. So when I see a pump up, I am looking for a move back down under that pump, which is where that move started, which you can see has occurred, right? But I'm going to give you a very, very easy setup. Okay, what I want you to look at is we've had this pump up. So keep this level in the back of your mind. Okay, so we notice that when we get this move down, London goes down. Where does it stop? Right, it stops right there, just above or at the same level as that pump up, where that pump up began, right? Now, I know from experience that the market wants to go below that level at least 25 to 50 pips, because that's typically where people have their stops, okay? So if anyone has bought on this move up, if they're still holding it, they're going to have their stops anywhere between 25 pips to 50 pips, okay? Each one of these boxes is 25 pips on my chart. That's why I have these lines. So it's easy to identify visually. I don't have to go and calculate it manually. Okay. So when you see this, where the market has come down, and look where it stopped. It stopped without taking out that low. Okay. The expectation is that it should actually come down at least to this level, because that there is 50 pips below that particular pivot point there, right? So when you see the market prior to the open of New York stop at that level and then start to move up, with very high probability, that is a pump up for a short that at a minimum will go through that level. So you can just exit as soon as you get back down to there, but most probably further down by another 50 pips. And that's what we can see here. It's actually quite a straightforward entry and very easy to identify. You're looking for an initial move up, can be on the same day, can be in the previous day, doesn't really matter when it's occurred. You're looking for a move that comes down close to that bottom, right? Key is you want to see the pump up prior to the session open, because that is where a move prior to the open session is false. Now, timing is important. This move up, which is a false move, should be at least 45 minutes to an hour, okay, which in this case it is. There's a few other things that you can also take into consideration which are important. I'm just expanding the chart a bit. I want you to notice the level of the movement up in terms of price. So we've already spoken about time, that we want it to be at least 45 minutes to an hour up. But now I also want to talk about how much in terms of price should it move up as well. So in terms of price movement up, you want to see at least 75 pips movement up on gold, okay? So each one of these boxes, as I said, is 25 pips. So we've got 25 pips. Another 25 is 50 pips. Another 25 is 75 pips. And it's even higher. Another 25 is 100 pips. Okay. So that's 45 minute to an hour of pumping up from the level that it should have broken through. So let me go back and show you. Let's actually draw a line there. So really the market should have continued to go down. Should have broken through that level. Okay. That level on the left-hand side, because that's a key level where the pump started and where stops are residing below. Let's actually draw a line there. Okay. And so, not that one. Let me grab this line here. Okay, you can see we've come in right at that level. I mean, isn't that magical? The bodies of those candles are sitting right at that low, and that's a low that really the market should have smashed through. Okay, and again, that's engineered that way. That's actually designed that way. That's the manipulation, because people, retail traders, they see that as a double bottom and they see that as support, so they start buying there. And so the market makers trick them, and they make them think that they are actually on the right hand side, but they are on the wrong side, and the market smashes through. Okay. Now, something else I also want to point out for you. We've spoken about how much time that pump up needs to take, 45 minutes to an hour. We've spoken about how much in terms of price movement that should be, okay, above 75 pips. In this case, it was 100 pips. And what that actually means is that if you do get in, then it's very easy. I mean, you're only looking for 50 pips, right? Very easy to make 100 pips back down to even just that low there, even though you've got potential to go another 50 pips because of the stop hunt from people who had entered that move on the left-hand side. So there's potential there to make 100 pips or more on that setup. Now, something I want to make clear is, well, where do you get in? Well, there's a couple of things, okay? Let's think about why the market's moving up. Well, number one, we've established that because of that double bottom, okay, from the level on the left that I've shown you, That is what the market makers want to use as a manipulation and trick retail traders into thinking that's a double bottom and therefore support. And that's one reason for why they are pushing this move up. Okay. Second reason is the market's moving up to rebalance a gap, which is for us a entry based on this setup. And that gap up here, when you get above that 75 pips, around that 75 pips, and you're getting close to that 45 minutes to 1 hour pump, look to the left and your entry should be on some level of gap. Okay, if you don't know what a gap is, go and look at my video on the channel. The Euro scalping strategy talks about gaps. Okay, and so that is the entry. Okay, now you can either enter there on the pump up, right, if you're confident, or just go down to a lower time frame, 5 minutes, 1 minute, and try and find an entry. Okay, and your stop needs to be above the candle that produced the high level of the gap. Okay, so it's actually this level up here, stops up around there. 25 pips is usually what I use as my stop for my entry, and that seems to be have worked well for me. But you need to practice and study the charts and identify a level that's within your own risk tolerance level. Once this move starts to move down, it should never come back. Okay, so you should immediately be in the green, right? Price should move in the direction that we're expecting immediately once these rules have been met. We've had the 45 minutes to 1 hour pump up. We've come into a gap. We've moved up at least 75 pips, which is really 3 levels of 25 pips each at the right time, right? This is all before New York open, and we're looking for a immediate push down at the start of the session for the objective, which is to, if I scrunch this chart up again, the objective is to pump up and smash down through these lows on the left. Okay, so you need to go back now and study the charts, identify this setup on other pairs. You'll see this on all pairs, and you'll see this occur and repeat at least once or twice a week on any pair. So identify the pump up. Okay, know that at some point that is going to be fully retraced. Look for, prior to the open of the session that market trades in, if we're talking about gold, well, gold typically trades in the New York market, and look for that pump up 45 minutes to an hour prior to the open of that session, moving up at least 3 levels of 25 pips each. And before you enter, you want to kind of find it, a gap on the left-hand side, okay, all at the start of the New York open, okay, the market open. And then your expectation is a move down. Minimum is back to this level, which is an easy 50 pips. If it's been going up 75 pips to 100 pips, most probable is another 25 to 50 pips below this level, okay. Hope it makes sense. Study your charts. I will now talk with you in a future video.